Well, the volatility has actually coincided with the end of the February COMEX contract. Now, the reason that's important is that if you have a build-up of speculative positions, then that is the time when the shorts, who generally are the swaps or the bullion bank trading desks, that's when they shake the trees. And that's more or less what we saw. The situation, I think, is compounded somewhat. There are various factors we have to consider. The first is the level of speculative interest. It is extremely low. So I doubt that there was very much in the way of long positions actually shaken out. When we look at what happened on Monday, there was a markdown on Monday, particularly in silver. And this coincided with the end of the options, the options for February, because that was the day, if you like. So they wanted as much as possible to get these options, call options, out of the money, so therefore worthless. So that explains that one. The big slide, which really started in the very early hours of Friday morning, had more to do, I think, first of all, there was a little bit of profit taking in China from the very high levels that we saw ahead of the weekend, which, any sensible punter, if I can call them that, would take his profits ahead of the weekend and say, well, Monday is another day. So there's a little bit of that going on. But the key point is that once China had closed, basically there was no interest from the Far East, and the swaps on COMEX, the members of the LBMA, the dealing banks on the LBMA, really had a free run to do what they wanted. And in the absence of really any meaningful speculative interest, they were able to make the price whatever they wanted. And that's basically what they did. And the reason that it was on Thursday, Friday, was that going into Thursday, the open position in the February contract was around about 38,000 contracts in gold. Now, not a huge quantity, but, enough. The point is that Thursday was the first position day. Now, what that means is that if you have got a long position on COMEX on that day, you could well be allocated, if you like, stock, which, physical stock, which you would have to pay for. So basically, you need to, unless you actually want the stock, and most dealers don't want the stock. They're just playing the market. You have to get out. You have to sell your position. You either make a loss selling your position, or alternatively, you roll it into the next active month, which I think is April. Now, even if you roll it into the next active month, you've got a mark loss. So you can see that all this is conspiring against the few speculators that were left, if you like, in that contract last week. And it just went from there. I mean, they just banged it as hard as they could, because remember, you're looking at a mark-to-market effect as well. And I think what it confirms is that the establishment, if I can call them that, swaps on COMEX, the dealers on the LBMA, the banks, the bullion banks on the LBMA, having been net long of gold last year, across the two markets, I think they'd lost that position and they were going short in gold. And also, of course, they're being very, very badly squeezed in silver.
Exactly. We heard a lot about that.
But the important point, Jasmine, is that now that expiry of the February contract is behind us, the reasons why the market crashed are also behind us.
Right.
Now, I think it would be a mistake to say, well, we've definitely seen the bottom and all the rest of it. But I think the likelihood is that we have seen the bottom. It's been a flash crash, if you like. Yeah, exactly. So on that basis, I mean, they could make more or less any price they liked. And that's what happened. The effect this morning, obviously, China wakes up and says, oh my goodness, look what's happened. And of course, the other thing that hasn't actually helped the speculators is the gradual increase in margins that they've got to place when they buy futures contracts. So that, I think, has also helped unwind potential interest, if you like, in futures. So they wake up this morning and find that everything's been marked down heavily. Now, having said that, in China, silver closed around about 103, I think, and then 111 on the futures exchange. Gold closed at something like 5,200. So we're well below where they closed in China. Yeah. I mean, what a wonderful opportunity. Did you ever think that you get the opportunity to, you might have missed it. So it's like, oh God, I wish I'd put more in. Now you can go in and fill your boots. I mean, get out of credit. What a wonderful opportunity. You've got to look on the bright side. And I think that's the sensible thing to do because, there's absolutely no change in the long-term risk. And by long-term, I think we're probably talking no more than 18 months now. I mean, I think this collapse could happen really very, very quickly.
Yes.
What a wonderful opportunity to hedge out of it. Go for it.
Well, I've been saying, like one or two other people, that I think that...
Well, the way I look at it is not so much the dollar going up, but the currency going down. And unless someone can convince me that there's going to be a politician or the central bank can take charge and actually protect the currency. Well, it's actually not the central bank, it's the US Treasury. Unless they really balance their books, throw up a credit, a positive number on their on their budget, then gold goes to infinity, measured in these dollars. Why? Because the dollar goes to zero.
Yeah.
The gold will retain its purchasing power. It varies a bit, yeah. And there's another thing, actually, in all this. Gold has been running ahead of other commodities. The result is that commodities are extremely cheap priced in gold. They are going a lot higher. And when you bear in mind that they're going to rise, I would say probably 3 or 4-fold at least in gold. In a declining currency, the price effect is going to be even more dramatic. So what's that going to do to inflation? Do we hear anyone talking about inflation in 2026?
No.
I don't.
No, good point.
I think we could see from the middle of 2026 onwards, we could well see inflation soaring to over 20% in the UK and also in the US. Why? Because of the currency effect. Most of that debt is actually productive debt. It is borrowed by companies actually making things to sell profitably. Now, that's something which we're rather lacking, I'm afraid, in our economy. And also, it's the same problem in America, which I think is one reason why Donald Trump is trying to talk the dollar down.
If you've been watching the markets over the past week, you'll know that what we've witnessed isn't ordinary volatility. It is the sort of controlled demolition that only happens around very specific calendar dates in the futures markets. And yes, once again, it's tied to the expiry of the February COMEX contract. Now, if you're new to this, you might ask, why does the end of a futures contract month suddenly unleash a price earthquake? And the answer is simple. It is the moment when the largest players in the system, the swaps, the bullion banks, the LBMA dealers, decide it's time to shake the trees. They're not doing it because speculators were massively long. In fact, speculative interest is at one of the lowest levels I've seen in years. They're doing it because at the moment of expiry, they have the power to dictate the tape, and in the absence of strong buyers, they make the price whatever suits them. But even then, if we're being honest, the setup going into this week made the smash almost inevitable. Monday's aggressive markdown, particularly brutal in silver, lined up perfectly with the options expiry for February. And you don't need a finance degree to understand why that matters. If the bullion banks can push call options out of the money at the last moment, they don't owe you anything. One quick downward shove, and suddenly thousands of contracts expire worthless. Just imagine waking up excited to see your option nearing profitability, only to find it smashed into dust by lunchtime. A trader on Twitter actually wrote, "COMEX is like playing chess with someone who flips the board the moment you start winning." And frankly, he's not wrong. Now, the more dramatic slide began in the early hours of Friday morning, and that one wasn't, strictly speaking, manufactured out of thin air. Some of it came from China. Yes, actual profit-taking in Shanghai after silver reached extraordinary highs. And I can hardly blame them. If you were sitting on massive paper profits heading into a weekend with geopolitical risk rising, wouldn't you say, let's lock some of this in and breathe? Chinese traders did exactly that. But what happened afterward is far more revealing. When China closed for the day, liquidity in the East vanished, and the Western bullion banks suddenly had what every manipulator dreams of: an empty playground. With speculative longs at extremely low levels, with China closed, and with the February contract approaching delivery, the bullion banks had a free hand to slam the price as hard as they pleased. And they did. The reason they were so aggressive was because Thursday marked the first notice day. the moment when anyone still holding a long position can be assigned physical metal for delivery. And bullion banks hate, despise, loathe delivery. It exposes the real weakness in the paper system. So they force longs to liquidate or roll into the next active month, April in this case. And rolling a losing position into April means crystallizing a mark-to-market loss. So between margin hikes and shock price declines, the tree shaking worked exactly as intended. Yet here's the interesting part. The part the mainstream financial media refuses to acknowledge. This entire event had almost nothing to do with real physical market weakness. In fact, it's quite the opposite. The physical market is the tightest I've seen in my professional life. Silver inventories in London are dangerously low, and much of what remains is ETF metal that cannot simply be tapped endlessly. Shanghai silver price closed around $103 spot and $111 on the futures exchange. Far, far above the Western smash price. That tells you everything. The East is bidding aggressively for physical supply, while the West plays accounting games in derivatives markets. And think about what happened when China reopened after the smash. They looked at COMEX and LBMA prices and said, "What on earth happened here?" They didn't panic. They bought. The arbitrage gap between East and West remains enormous, but delivery constraints, export restrictions, and logistical bottlenecks prevent efficient arbitrage. So the price difference persists, and the West continues believing the illusion that silver is abundant simply because a few banks hammered paper contracts into the floor. Meanwhile, here's the deeper issue nobody wants to confront. The bullion banks were net long gold last year, heavily long. And now? They've quietly slipped back into short positions just as physical demand is accelerating. They are also catastrophically squeezed in silver. And when you combine dwindling inventories, structural deficits, refiners operating at full capacity, industrial demand surging, and Asian buyers gobbling up every available ounce, you begin to understand why the banks needed this smash. They're underwater, and when these institutions are underwater, they don't admit defeat. They change the rules of the game. But now that the February contract is behind us, the reasons for the crash are behind us as well. Does that guarantee we've seen the bottom? No, nothing in markets is ever guaranteed. But in my view, the probability that this was the bottom is very high. It has every hallmark of a flash crash engineered for a specific calendar purpose, not a genuine reversal of long-term pricing trends. And here's the irony. In China, silver's spot price was still over $100 when the London market opened. Gold closed at roughly $5,200 in Shanghai. So what did the West achieve by smashing it? They created a sale. They handed physical buyers the opportunity of the decade. If you missed buying at the previous breakout, now you have the chance to fill your boots, as the British say. It would be like walking into a Ferrari dealership and being told, "We accidentally marked everything 70% off for the next 24 hours. Do you complain? Or do you grab the keys before they fix the sign? Because nothing fundamental has changed. Nothing at all. The long-term risk to the global monetary system hasn't evaporated. Quite the contrary. The time horizon to a structural currency crisis has shortened dramatically. And by long-term, I don't mean decades. I mean perhaps 18 months, perhaps less. In fact, everything I'm seeing suggests the collapse of unprecedented scale could occur much faster than analysts were predicting even 6 months ago. This is because the core issue isn't interest rates. It isn't banking liquidity. It isn't treasury auctions failing. It isn't geopolitical tension. It is the simple, undeniable fact that the Western world has no plan, none whatsoever, to protect its currencies. Unless someone can convince me that the US Treasury and Congress will suddenly balance their budget, run surpluses, and begin paying down debt, then the purchasing power of the dollar must fall. And if the dollar falls at the rate indicated by the behavior of gold, then measured in dollars, gold will go to infinity because the dollar will go to zero. Not metaphorically, literally. Gold will simply retain its purchasing power while the currency collapses around it. And here's another concept that's extremely important. Commodities priced in gold are historically cheap. People don't talk about this because they think in fiat units rather than in real money. But priced in gold, global commodities are severely undervalued. Which means that in a fiat currency collapse, commodities won't merely rise, they will multiply. Threefold, fourfold, possibly more. And when you combine sharply rising commodity prices with a sharply falling currency, you get something modern economists pretend cannot happen. Runaway inflation. Not 5%, not 8%, but 20% or more. And unlike the inflation of 2021 to 2022, which was supply chain driven, this inflation will be monetary. Persistent, violent, and impossible to control. Do you hear policymakers preparing for that? No. Do you hear analysts discussing what happens when a currency loses 60% of its purchasing power in a year? Number. Do you hear anyone preparing the public for 2026, which in my view will be the year inflation goes vertical? No. Because the West does not think in those terms anymore. It cannot imagine a world where its own currency collapses. And this inability to imagine is precisely why the collapse is now inevitable. Meanwhile, gold is speaking louder than any speech from the Federal Reserve. The price action is the verdict. And the verdict is clear. Western currencies are terminally ill. The only question now is the timeline.